Hey, what's up, everybody? I'm Eric Waltzman, and if you're keeping your emergency fund in a regular bank savings account right now, you're literally watching your money lose value every single day. I know that sounds dramatic, but when I finally understood this, back when I was grinding through my debt payoff, it changed everything about how I store my cash. Quick heads up, this is for educational purposes only and not financial advice. Here's the deal. The average savings account at big banks like Chase, Bank of America, and Wells Fargo pays around 0.01% interest. That's not 1%. That's 1/100th of 1%. Meanwhile, inflation over the last few years has averaged around 3 to 4% annually. So if you have $10,000 sitting in a typical savings account earning basically nothing, you're losing roughly $300 to $400 of purchasing power every single year. That money isn't just sitting still, it's actively shrinking in terms of what it can actually buy. Your bank is using your deposits to make loans and investments that earn them way more, and they're giving you virtually nothing in return. Today, I'm breaking down exactly why this happens and what you can actually do about it without taking crazy risks or locking up your money where you can't reach it. The first thing you need to understand is how insanely low traditional bank interest rates actually are and why banks get away with it. Banks get away. When I started tracking this stuff during my debt payoff journey, I had about $2,000 in my emergency fund sitting in a regular savings account at a major bank. I was earning literally 20 cents a year in interest. 20 cents. I found more than that in my couch. Meanwhile, that same bank was turning around and lending my deposits out at rates anywhere from 4 to 20% depending on the product. The reason they can pay so little is simple: convenience and ignorance. Most people just use the savings account attached to their checking account because it's easy, and they don't realize there are better options. Banks count on that inertia. They spend billions on branches and advertising to keep you comfortable, and in exchange, they pay you almost nothing. The big banks can get away with this because they have huge infrastructure costs, but also because they know most customers won't leave over a few dollars. But here's the thing, those few dollars add up. On a $10,000 emergency fund, the difference between 0.01% and 4% is roughly $400 a year. That's real money. The concrete step here is simple. Log into your savings account right now and check what interest rate you're actually earning. Write it down. Most people have never looked, and that number is going to make you mad enough to take action. The second thing is understanding what inflation actually does to your cash over time. Inflation isn't just some abstract economic concept. It means the money sitting in your account buys less stuff next year than it does today. Let's use real numbers. If you have $5,000 in savings today and inflation runs at 3.5%, in 1 year, that same $5,000 has the purchasing power of about $4,825 in today's terms. You didn't spend a dime, but you lost $175 of real value. Over 5 years at that rate, your $5,000 would have the buying power of about $4,200. That's a 16% loss in what your money can actually do for you just from letting it sit somewhere earning nothing. The action step: calculate how much purchasing power you've lost. Take your current savings balance, multiply it by 0.035, and that's roughly what you're losing each year to inflation if your interest rate is near zero. Write that number down next to your interest rate. Let it motivate you. Here's where this got personal for me. In 2019, I had $3,200 sitting in a Chase savings account earning 0.01% while I was trying to knock out credit card debt. I did the math one night and realized I'd lost over $100 in purchasing power that year just to inflation, while Chase earned maybe 12% lending that same money out on credit cards. I was literally funding the same system that was charging me interest on my debt. That made me so angry I opened a high yield account the next morning and moved every dollar. That one decision put an extra $140 in my pocket that year, money that went straight to my debt payoff. It was the wake-up call I needed. Third, let me introduce you to high-yield savings accounts, which are the simplest solution most people don't know about. These are FDIC-insured savings accounts, just like your regular one, but they're usually offered by online banks that don't have the overhead costs of thousands of physical branches. As of right now, top high-yield savings accounts are paying somewhere between 4 and 5% annual interest. My money is completely liquid. I can transfer it back to my checking account in 1 or 2 business days if I need it. It's still insured up to $250,000 by the FDIC, so there's no additional risk. But instead of earning pennies, I'm actually earning real interest that keeps up with or even beats inflation. On a $10,000 emergency fund at 4.5%, that's $450 a year versus $1 at a big bank. Over 5 years, that's over $2,000 in extra interest, and that's assuming you never add another dime. Some popular options include Marcus by Goldman Sachs, Ally Bank, American Express Personal Savings, and Discover. I'm not sponsored by any of them. I'm just telling you what exists. The step here: open a high yield savings account this week. It takes maybe 15 minutes. You can keep your old checking account for daily spending, but move your emergency fund and any other cash savings into an account that actually pays you. Fourth, let's talk about the fear that stops people from making this move. The biggest objection I hear is, but what if I need my money right away? Here's the reality: high yield savings accounts are not locked. You can access your money. Most allow up to 6 withdrawals per month, which is way more than you'd ever need for an emergency. Transfers usually take 1 business day, sometimes 2. If you're really worried, keep like $500 in your old checking account as a same-day buffer and put the rest somewhere it'll grow. When my car broke down 2 years ago and I needed $1,200 for repairs, I just transferred money from my high-yield account to checking. It showed up the next business day. I paid the mechanic. Done. No drama. The other fear is, what if the bank fails? That's what FDIC insurance is for. As long as you stay under $250,000 per account, your money is backed by the federal government, same as any big bank. Your action step: write down your biggest fear about switching, then Google it. You'll find it's almost always not a real problem, just unfamiliarity. Fifth and finally, here's my hot take that might ruffle some feathers. I actually think keeping a massive emergency fund is overrated for most people once you have good income stability. A Bankrate study from 2023 found the average recommended emergency fund is 6 months of expenses, but most financial emergencies people face are under $2,000. If you've got solid health insurance, a reliable car, and stable income, you're probably better off keeping 3 months of expenses in a high yield account and investing the rest in a taxable brokerage for better long-term returns. I'm not saying have no emergency fund. I'm saying the oversized emergency funds most gurus push often just create cash drag that costs you real wealth over decades. Keep enough to sleep at night, earn good interest on it, but don't let fear park $50,000 earning 4% when it could earn 10% over time elsewhere. So here's the bottom line. Your regular bank savings account is paying you almost nothing, while inflation eats away at your money every single day. High yield savings accounts pay 10, 50, even 100 times more interest with the same safety and almost the same convenience. This is one of those rare no-brainer money moves. Now I want to hear from you. What interest rate is your savings account paying right now? Drop it in the comments, even if it's embarrassing. Let's see how much money we're collectively leaving on the table. And if you found this helpful, hit that subscribe button, because next week I'm breaking down the 3 budget apps I actually tested while paying off debt and which one is truly worth using. Thanks for watching, and I'll see you in the next one.